Okay, everybody, welcome to the weekly update show, November 15th, 2020. I am on the road. We got some new tech gear, so hopefully the audio is much better for you guys when I'm not in the studio. Conan, we weren't able to figure out a way to get Conan in on this with me, so hopefully this will be the last time, but you just get me for this recording, and we will press on. Okay. We got quite a few things to go over this week. So let's start with the standard quote, and I'm going back to Warren Buffett. Do not save what is left after spending, but spend what is left after saving. Another way to say this is pay yourself first. There are a whole bunch of other ways of saying the same thing. The idea is that you want to focus on basically saving for the future. So make that the priority. In this case, it's do everything you can to max out how much you're putting into TSP every payday. The value of compounding, you can't say enough about it. It's math. The value of compounding is critical. The earlier you are in your career, as you go later in your career, it doesn't have the same effect. So really, as soon in your career as you can, budget in such a way that you're maxing out TSP first and spending what you have after that. It was quite a week on the market. I can barely remember back to Monday, but that was really the biggest day of the week. Extremely volatile week, and Monday was the biggest day. C Fund closed up 2.16%. S Fund was up 2.18%, and I Fund up a whopping 4.77%. So Monday was by far the biggest and most volatile day. And intraday on Monday, we got the intra-week high for the S&P at 3650. So if the S&P had stayed at that level and closed there on Monday, we would be officially outside of this megaphone pattern. I mean, that would have been a huge follow through day, and it would have caused a lot of hate and discontent for people that missed it. But as it was, it reversed. So it reversed on Monday, not all the way back down. We'll take a look at it, but it closed below 3,600 for the day, and then during the rest of the week, the market tried to get back above it and never could. So we closed the week on the S&P about 35.85. But what we did get this week was a really healthy sideways consolidation that allowed the 10-day moving average to almost catch up to the price, which is really good because hopefully we'll get support there at the 10-day and the downtrend line. We'll take a look at that. And so hopefully that sets us up for a move higher. The S Fund continues in its 6-month uptrend, higher highs and higher lows. It should not say lower lows, it should say higher lows. So the F Fund is in a great upward channel, higher highs and higher lows. The I Fund gapped way up out of its multi-month consolidation pattern. So the I Fund is definitely something to look at. The 6-month chart on the I Fund looks great, but then we look at a longer term chart and see some serious potential resistance at about 70. So we'll take a look at that. The two things to really think about here for this weekend's weekly update show. We've talked about this quite a bit over the last few weeks, and we get it all the time, especially when the market is volatile, which it has been for the past couple of weeks. People want to know, if I get into the market now, I've missed a big move from the bottom, so should I get in now? And if I got that big move from the bottom, should I consider moving to the G Fund now? And I really hesitate to answer those questions because they're really not. There's no direct answer. There's no one size fits all answer to those questions. So as we go through the charts here, just think about your personal risk tolerance and where you are in your career, how aggressive or conservative you are in general, and specific to TSP investing, right? Whether or not you're going to need to use TSP to supplement your monthly income, or is TSP something that is great to have on the side, but you're not planning on on having to draw from it right away at retirement. I mean, there are so many things to consider that what seemingly is a simple question, right? What should I do now? It's not something that I can answer, collectively. So what I've done, and a bunch of you guys have taken advantage of it. I've been doing coaching calls since March. Right, so I got some time back when COVID began, and I'm still able to do it. So basically, the coaching calls, what we do is it's an hour-long call, and what I do is match up your personal risk tolerance and circumstances with where we are right now in the market. So if that's something you think you want to do, please send me an email at jerry@growmytsp.com, and we'll set up a coaching call. It's really helpful to answer specifically this question within what should I do now, right? Within the scope of your personal circumstances and risk tolerance. So if you want to do the coaching call, hit us up. If not, that's fine. Just think, as we're going through the presentation, think about your personal risk tolerance and how that comes into play in terms of both the big picture charts and the shorter term daily charts. Okay. Before we get to that, real quick, Facebook, where we've got a ton of new members to the group this week. So welcome aboard. That's awesome. It was also a little bit of a strange week. Obviously, we're coming off the election, and there's some like politically related posts and comments and things. And so let's just try to keep the group apolitical, not apolitical. Everybody has positions and opinions and all that, but it's a TSP related group. So please don't go over the line and make it political. Okay. And then finally, I guess one last thing that I have written down here in my notes, because it was a comment in Facebook somewhere. So a lot of people have this idea of, I'm never gonna reallocate to the G fund because I have plenty of time for the market to recover, right? On the other hand, you could have the mindset, I'm staying 100% in the G fund. I don't have time for the market to recover. So both of those sort of mindsets at the extremes will not help you. There's always a time for the G fund, and there's always a time to be in the stock funds. They're tools. You just have to know when to use the tools and how they relate to your personal circumstances. So, for example, if you are retired now and you're not contributing it to TSP anymore, and you need that TSP to supplement your monthly income, when we look at the first chart here, or the first couple of charts, you'll see that we're still at the top of this megaphone pattern. We haven't broken out of it yet. So the market risk is really high right now in a big picture perspective. So if I'm retired, I might look at this long-term chart and think, okay, I might not want to be in the stock funds right now. On the other hand, if I'm, just starting my career, or I still have decades more to contribute into TSP and or my IRA, I might look at this and say, okay, I'm willing to risk the downside to get the upside, right? So it's a very personal. It's specific to your personal circumstances. Okay. All right. So let's get into it. Okay. This is the long-term best case scenario. Okay. We started down here at the bottom in 2009. If this Elliott wave count turns out to be correct, we got 1, 2, 3, 4, 5. So the next move down should be 1, 2, 3, or ABC. In the case of this COVID crash, price-wise, it collapsed 34%, and it went below this 4 level. So technically, according to the rules, that's a reasonable count. If that's a reasonable count, then we got back at a high here, which would be a 1. Then we have an A, B, C consolidation, and then it moves higher. Okay, so this would be 2 at the C. So we got 1, A, B, C is 2, and then we move higher, and somewhere up here we get 3. That's the long-term bullish scenario. So if you are, if you're able and willing to be more aggressive, you might look at this bullish scenario and say, okay, that's my plan A, right? If, on the other hand, your circumstances don't allow you to be aggressive, or if you're just conservative, let's say by nature, you're going to look at the same chart, right? But the possibility is a little bit different. So here we are right now. Okay. We are just barely outside of the upper channel line. So you might say, okay, we're outside of it. We're outside of it. I'm going to call it good to go, and we're going to go higher from here. On the other hand, you might be conservative a little bit and say, well, we're outside of it, but we're not outside of it enough. I'm gonna let it play out until, you know, the S&P closes above 3,600 or 3,650 or so, whatever number you think pretty much guarantees that we're outside of that channel. Because once we're outside of the pattern, you know, if it's to the upside, we're good to go. If it goes to the downside, you know, it's a huge move down. I mean, it's a 50% loss basically from 35.85 to whatever 1750 is a big move down. Not that you would take that move, but we're going to talk about that as we drill into the charts. But from a long-term perspective, do you want to be, if you are able to withstand some risk, maybe you stay in the stock funds here. If you're not able to sustain, you know, some losses, you might consider being in the G fund until we are definitely out of this pattern. This is the 13-year weekly chart. Okay, so don't misunderstand. We're going to drill down into the shorter term weekly and the daily. And the daily charts are where you really want to make reallocation decisions. This is more of a perspective. The longer term charts give you sort of a come from. Hopefully that makes sense. Okay. So in this case, we just took the S&P chart, drilled it down to 5-year weekly, and you can see the consolidation a lot better. So if we got, I mean, we closed at 35.85 this week. That is dead on that upper channel line. If we get a close up here, right, somewhere up there, 3650 to 3700, we are out of the pattern, clearly. On the other hand, if the market rolls over and we get a close down here below 3200, it's very likely that we're in the bearish scenario. Okay. So this is a little bit closer of a chart that we can use to make reallocation decisions. Why is that? Because from 35.85 to 32.25, I think it is a 10% move. So when you look at this in terms of your personal risk tolerance, if we're going to wait for a close below 3,200 before we decide whether or not the bearish scenario is the one that's in play, we're accepting about an 11% loss from where we are right now before we make the decision to reallocate. So it's something to think about. Are you able and willing to risk that 10% loss? On the other hand, if you wait if you're in the G fund now and you wait to move into the stock funds until the market is up here at 3,700, it's a 3% move to the upside. So from 35.85 up to 3,700 is about a 3% move. So the risk The downside risk is about 11%. And the risk to the opportunity cost, basically, if you don't get in, if you're not in the stock funds now, is about a 3% move to the upside until we know that we're out of the pattern. All right. So this is actually a really good chart, I think. Basically, understanding this range right here is kind of critical. It's 11%. So having said that, you don't have to take the 11% loss, right? So now we're looking at a 6-month chart of the C fund daily, okay? And we have the short-term trend line. We got the 10-day moving average, the blue line. We got the 50-day moving average, the red line, okay? The daily charts are the ones that we use to make reallocation decisions. The weekly and monthly charts that go extend over 14 or 15 years, those are the charts that we use to give us context that help us make the daily decisions, okay? So in the big picture, we are still right on that megaphone pattern at the top of it. We're not out of that pattern yet. In the daily picture, which is here, 6-month daily, we broke out that gap up on Monday. The gap up on Monday took us out of the downtrend, took us above the downtrend line, right? It was huge. It was a huge day. If we had closed up here, right, we would definitely be both out of the short-term pattern that we're looking at and out of the longer-term pattern, but it reversed. So we talked about candlesticks before. The market gapped up at the open to the top of the black on this candlestick, went all the way up to 36.50, and it came all the way back down to 35.50 and closed at the bottom of the black part of the candlestick. So there was a lot of sort of momentum or anticipatory buying that pushed it all the way up there. But at the end of the day, the market couldn't sustain that level at that point. So it reversed and came back down. The awesome thing for us is the next day, right? The next day, the market was, the S&P was lower a little bit, but it came down, got support at that trend line, and moved back up. Okay, so Monday we had this huge explosive day. Tuesday we came down and got support. We filled the gap, got support at the trend line, and then Wednesday, Thursday, Friday we went sideways. This is actually a great chart. Again, no guarantees, but the 10-day moving average, the blue line, was way below the price. So right here, when on Monday, the 10-day moving average was down here around 3,400. And the price was up here at like 35.50. So the gap is risk, right? The further the price gets from the 10-day moving average, the more risk we have, because at least the more risk I have, because I am going to wait until a close below the 10-day moving average before I make a decision to move to the G fund. So now, over the last several days, the 10-day moving average has come up, and it's only like a percent or so. I haven't worked out the numbers yet, but it's basically intersecting the downtrend line, and it's very close to where the bottom part of the price on Friday. So what I'm saying is the market risk, from my perspective, has been reduced significantly this week because the market consolidated sideways. I mean, it didn't have to go sideways. It could have gotten to this point, did the reversal up here on Monday, and then kept coming down and broke the 10-day moving average, right? It could have done something like that, and then consolidated like at the 50-day, say, but it didn't, right? It went sideways, and so again, no crystal ball. What I'm expecting is we had a really good move here. We get some sideways consolidation, and we have support at this trend line, and we get support now at the 10-day moving average. So could we come down a little bit, maybe down to 3,500 over the next couple of days? Absolutely. As long as we still have support at the 10-day moving average and this downtrend line, we may go sideways for a couple days, but we should go up from here. For how long, who knows? But my plan A is that we go up from here. Okay. A lot of anybody who missed the alert last Wednesday, that was the alert day right there last Wednesday. Okay. If you had gotten in on Thursday, if you missed Wednesday and you got in on Thursday, that's where you would have gotten in. So there was no way to know this at the time, of course. And at the time, if you had gotten in, you were pretty far above the low, right? Which was what a lot of people were concerned about. No doubt about it. I mean, you were probably 10%, at least 12% above that low. However, if you had gotten in back into the stock funds there, you'd be higher now, right? Not only would you be higher, but you'd be getting in at the support level. And this all is because the market went sideways this week. Now, there was no way that we were going to know that. That's why I keep saying we respond to what the market tells us to do. I couldn't anticipate that the movement was going to be sideways. If we had seen something more like this, where it came back down, we'd be talking about something a little bit different. But that's not what happened. It went sideways, and that gave it an opportunity for the 10-day moving average to catch up to the price, which is going to provide support going forward. So when again, going back to the beginning of what I was talking about at the beginning, these questions about I missed the move, what should I do, are really unanswerable questions. There's risk either way, and in this particular case, right, I won't say it was we won or whatever, but in this particular case, because the market went sideways and the 10-day moving average was able to come up and catch up to the price, it would have been a good move to get in either the Wednesday or the Thursday or the Friday, right? Anywhere in here that you got in, if you got in anywhere in there, it was a good move. Why is that a good move? Because now the 10-day moving average and the downtrend line are providing support to where the price is now. That's why it's a good move. And you couldn't have known that, right? That's knowing it in hindsight. Okay. Okay. All right. So the S fund, like we said, is in a really good higher high. So we got a higher high, still got a higher high, right? We got lows here, higher low, higher low. So we're in a pretty good channel for the S fund. The only thing to keep an eye on is that as we draw the short-term upper trend line, which is this line right here. So we connected this high, this high, this high, this high. We are consolidating right now just below the upper trend line. So as the 10-day moving average on the S fund comes up, the red line, as it comes up and meets the price, this upper trend line is resistance, right? Because every time back here, every time it's hit that trend line, it's rolled over. So if you are risk averse or conservative and you're looking at this chart, you're saying, it seems to me that in the last 6 months, every time it's hit that line, it's rolled over. So maybe now's a good time to get out of the S fund. That's absolutely what this chart would be telling you. Now, you also look at it and say, okay, it always, if it comes down, it hits that trend line and rolls over, it usually finds support at the 10-day moving average. Not always, because sometimes it breaks through. But when it does break through the 10-day moving average, it almost always finds support at the 50-day moving average. So what does that mean? If you get out of the S fund now, and it comes down to the 10-day moving average, and then goes back up, you're kind of stuck, right? You've got a very little difference there even if it comes down to the 50-day, because the chances are it's going to stay a higher low and keep on moving, right? So the bottom line is I would be aware and be mentally ready for the S fund to roll over a little bit, but I wouldn't be bailing on the S fund because of this chart. I fund. We've been talking about this horizontal channel in the I fund for months, and it exploded out. Price exploded out of this pattern on Monday on giant volume. So this actually is the most interesting thing here, because the this volume, big volume, actually started back here on this gap right here, and it's continuing as we go through the upper channel line. So it was huge move. If I'm looking at this chart, I'm absolutely buying the I fund. It came out of a relatively long consolidation pattern and exploded higher, huge gap up on big volume. So if I'm short term looking at this, I'm absolutely buying it. Then I expand out the chart a little bit and take a look just to make sure I want to buy it. Here's a weekly perspective, 14-year weekly. So this chart actually doesn't look great, right? You got a top here at about 70, a top here at about 70, and a top here at almost 70. So if I'm looking to get into the I fund, I'm not going to do it yet. I'm going to wait, because we're right there at almost at 70. We're at 69.37. I'm going to let the I fund come up to probably 70.50, $70.50. So here's the 70 line. Actually, I might even let it go up to 72, because these are $5 or $2.50 block chains. I would probably, I mean, if we're somewhere up here, then we're definitely out of the pattern, right? And this pattern, this pattern is worse in terms of Megaphone. This is worse, right? If the I fund can get above 70, and then instead of 70 being a ceiling, it becomes a floor, it's hugely bullish for the I fund. And honestly, that's kind of what I expect, but I'm not putting on the the crystal ball hat. So watch that 70 level closely, and if it gets above it, especially on a weekly basis, I think the I fund is probably a place that, as we get later in the month, if we did get support above that 70 level, I would definitely consider moving into the I fund. But those are a lot of ifs. Okay. So the bottom line is, from a big picture perspective, we are not out of the Megaphone pattern, either on the I fund or on the C fund. The S fund is in great shape, but the I fund and the C fund, we're still in the big picture pattern. As we drill it down, especially to the daily chart on the C fund, we're in great shape, right? So definitely look for support at the 10-day moving average line and that downtrend line on the daily chart of the C fund. Okay. It is way more fun for me to do this with Conan in the podcast studio. Speaking of the podcast studio, we're making some improvements in there. We got a new tables, and we're gonna restructure the cameras a little bit, and so we're definitely looking forward to kind of bringing more value to the whole thing. And I think it's going to look a whole lot better next week. Okay. So I'm going to sign off here from some remote hotel location somewhere in the world. And I will see you guys next week. Have a great week. Cheers.